Welcome back to the deep dive. Today we are taking a really fascinating trip into this intersection of fan culture, profitability, and, well, a whole lot of corporate debt. We're unpacking the Funko Inc. Q3 2025 earnings call, which took place back on November 6th.
In this deep dive, it's really tailor-made for anyone trying to understand modern market psychology.
Oh, absolutely.
Because on paper, the results were, mixed. You had a solid profitability beat, but then a pretty significant sales miss.
Yeah, and yet the market reacted with just immediate, sharp enthusiasm. The stock climbed over 10% the next day.
It did.
That spike tells a story, doesn't it? So our mission today is kind of twofold. First, we need to understand exactly how the new management team, executed so well on the bottom line that investors were willing to just completely forgive that drop in sales. And second, we have to assess the credibility of the strategic roadmap they laid out, the one they call Make Culture POP.
Right. It's a classic assessment of potential versus performance. The market is betting heavily on the execution of this turnaround plan, led by the new CEO, Josh Simon.
So let's look at the numbers and see what justified that faith.
Let's do it.
Absolutely. Let's start with the headliners. They crushed expectations on the earnings front. Adjusted or non-GAAP earnings per share came in at 6 cents.
6 cents, and the consensus estimate was just 3 cents, so they doubled it.
That's a huge win on efficiency.
It is, but you have to pair that with the top-line disappointment. Total revenue landed at $250.9 million.
Which missed the street's estimate of $261 million. And maybe more importantly, that's a 14.3% decline year over year.
Yeah, a 14.3% drop is massive.
So how did they possibly frame that number so the street just looked right past it? I mean, that is serious top-line softness.
Well, the narrative has completely shifted. It's moved away from growth at any cost and toward profitable growth and operational discipline. The market essentially said, we don't care about sales right now. We care that you can make money on the sales you do have. And the profitability indicators were really the driving force behind that belief.
Which brings us to adjusted EBITDA. For everyone listening, that's earnings before interest, taxes, depreciation, and amortization. Basically a proxy for operating cash flow.
Correct. And adjusted EBITDA came in strong at $24.4 million. Significantly higher than expectations.
So that tells you they generated a lot of operating cash before dealing with that heavy debt burden.
Exactly. This wasn't about selling more stuff. It was about selling the stuff they did sell much more efficiently. And that whole story, it starts squarely with margins.
Right. That efficiency really starts with what we're calling the gross margin triumph. That key metric hit 40.2%.
That 40.2% margin in this environment, that is impressive.
Yeah.
For listeners who might not be tracking this daily, gross margin is the profit percentage you have left after the cost of the goods themselves. When that number is high, it speaks volumes about brand loyalty, pricing power.
And this result keeps Funko's gross margin in that 40% plus range for 6 of the last 7 quarters. That consistency is something the street rewards heavily.
And here's where it gets really interesting. Management successfully implemented price increases, which helped fully offset the impact of increased tariffs.
To successfully pass along costs to consumers who are already feeling, inflationary strain, that's a testament to the brand.
It is. You don't raise prices and maintain margins like that unless your core collector base is just incredibly sticky.
And you see that execution discipline flowing straight down the expense sheet, specifically in SG&A.
Right, SG&A, which is your selling, general, and administrative expenses, so all their non-product overhead. Salaries, rent, marketing, all that.
Exactly. And they were ruthless here. SG&A expenses were cut down to $79.8 million, which is way down from $92.7 million last year.
That's a massive, $12.9 million cut.
And they told exactly where it came from. Half was from cost reductions they started back in Q2, and the other half came from pulling back on marketing spend.
I do want to push back on that last point, though.
Okay.
Cutting marketing spend is a classic short-term move to boost your margin, but it could be a robbing Peter to pay Paul situation.
You mean you stabilize the margin now, but maybe you damage long-term growth?
Exactly. That's the trade-off. And we saw the immediate side effect of that pullback in their direct-to-consumer or DTC sales mix.
Right. DTC sales dropped a little to 18% of gross sales, down from 20% last year. That's the cost of prioritizing that immediate profitability.
And if we look at the actual product mix, both segments are still navigating some macro headwinds. Core collectibles revenue was $200.4 million, down 12%.
And Loungefly, that's their apparel and accessories brand, also dipped 5.5% to about 45 million. So the efficiency gains are hiding the fact that both main product lines are shrinking.
Which is why we have to connect this to the bigger financial picture, the balance sheet.
The most critical piece of the puzzle, they have about 39 million in cash, and their inventory discipline is really strong, down to just under 100 million. That reduction is healthy.
But the shadow over the entire operation is still the debt. Total debt remains elevated at $241 million.
So while the operational execution is phenomenal, that debt situation, which actually triggered a going concern disclosure in their filings, is still absolutely a watch list item.
They've stabilized the patient, but the clock is ticking on the refinancing.
Which brings us directly to the strategic storyline. They've stabilized the margin, but how do they restart real top-line growth?
This is where the new CEO, Josh Simon, steps in with the Make Culture POP playbook. He's framing it as a transition from financial cleanup to controlled defense.
And Simon's background is key here, right? He's from global consumer products at Netflix, Disney, Nike.
Exactly. He understands fandom, he understands IP, and the life cycle of cultural trends on a global scale.
Yeah.
He is, arguably the right person to build this strategic narrative.
So that control defense is built on 3 pillars: culture, creativity, and commerce. Let's start with culture, which is all about speed to market. Their quick strike offense.
The goal is simple. Identify micro trends faster and just supercharge their time to shelf. The key example they used was the KPop Demon Hunters lineup.
Which is tied to that popular Netflix movie.
Right, and that story is genuinely impressive. That lineup became one of their biggest pre-sale items, and they got the physical product to market in just a couple of months.
A couple of months. Simon noted this positioned Funko as one of the only toy companies with product on the shelves for the holidays. That is amazing velocity.
It really is, and it raises a big question. How big of a competitive moat is that speed? Traditional toy companies can have, 12 to 18-month cycles?
If Funko can consistently operate in that 2 to 6 month window, they can capitalize on trends like K-pop, music tours, Twitch streamers, before anyone else, really.
The Stephen Colbert 10th anniversary pop was another great example of that cultural crossover ambition.
They also spent time acknowledging the core collector base, which is, it's crucial for brand health.
Absolutely. They committed to rebuilding credibility there with their execution on limited editions and the drop cadence. And the proof was, in the Q3 drops, some limited edition pops sold out within an hour.
So they still know how to drive that scarcity and collector hype when they get the execution right.
And tying back to the core structure, we can't overlook the licensing mode. They renewed these critical multi-year deals with Disney. So that's Pixar, Marvel, Lucasfilm, Warner Bros., NBC Universal.
All the big ones, Paramount, 20th Century, those renewals are the foundation. They confirm Funko's position as this global IP platform.
Right. Now let's move to pillar 2, creativity. This is about adding new dimensions to the core POP franchise, and the undisputed star here is Bitty Pop.
Oh, Bitty Pop is the major win for the quarter, arguably the biggest driver of confidence for the street because it's generating new retail excitement.
These are the tiny vinyl figures, and they're getting prime real estate. Bitty Pop is now on Walmart's prestigious 2025 top toy list.
And it was featured in their toy book catalog, which gets sent to over 40 million homes.
And crucially, management confirmed that out-of-aisle placement is planned for 1,800 Walmart stores.
That placement isn't just retail space. It's a strategic shift into the impulse buy category. Right next to the checkout lines, high traffic areas. That's a massive volume opportunity.
For sure. And this creativity isn't stopping there. They're expanding the blind box format beyond Bitty Pop, growing mystery minis, and launching a new premium blind box line that's more artist-driven.
So a diversification away from just the standard 4-inch pop figure. They're realizing they're an IP platform, not just a vinyl figure company.
Precisely. Which brings us to the final pillar, number 3, commerce. This is the path to re-accelerating growth. It's about international expansion and smarter DTC.
International, especially in Asia and Latin America, is a huge focus for Simon. It makes sense given his global consumer background.
Right. He sees a clear lane for Funko to excel in places where that whole fandom lifestyle concept is just starting to mature.
And the DTC enhancements are straight out of the modern tech playbook. They're simplifying the website, the app, but the real headline here is the new AI-powered builder coming to Pop Yourself.
Yeah, that AI feature is huge. It lets users upload a picture for quick customization recommendations.
It just removes friction from the process.
Exactly. Right now, making a custom pop takes a few minutes. If AI can cut that to 30 seconds, they move from a novelty item to a major mass market product.
They are also getting creative with physical retail. They mentioned the Pop Yourself kiosks at places like the Inter Miami Stadium.
And the plan to use vending machines for Bitty Pop products, it adds that mystery element. It's all about meeting the consumer where they are digitally and physically.
Okay, let's pivot to the investor context. What are the near-term signals, especially with the holiday season coming up?
So the Q4 guidance was qualitative, but it was firm on margins. They guided for net sales to increase modestly versus Q3.
So nothing stellar on sales.
No, but the crucial point was maintaining gross margin at approximately 40% and adjusted EBITDA margin in that mid to high single-digit range. The priority is still consistency and profitability.
We also need to talk about that retailer caution because it really explains the Q3 sales miss.
Yes. Global unit point of sale, or POS, that's the consumer actually buying the item, was down only 3% globally. That's relatively stable demand.
But the U.S. market saw mid to high single-digit declines, while EMEA, so Europe, Middle East, and Africa, was actually up low double digits.
So that tells us the consumer is still buying the product when it's on the shelf. But U.S. buyers, the retailers themselves, were extremely cautious with their orders in Q3.
They're selling.
Right, they're selling. And that caution was likely due to uncertainty around tariffs and the general economic environment. Retailers are just managing their inventory risk very aggressively right now.
And circling back to that debt overhang, because we have to, the company is fully aware of that $241 million shadow.
The refinancing process is front and center. They executed an amendment to their credit facilities, which mature in September 2026, and that waived the Q2 and Q3 financial covenants.
So it buys them some time?
It does. But the process is actively ongoing. The bottom line is this debt situation underscores why execution, speed to market, and cash generation are immediate, non-negotiable priorities for them.
The near-term catalysts run straight through the holidays then. Strong Bitty Pop, sell-through at Walmart, stabilizing Loungefly, and seeing if these quick strike strategies actually translate to measurable, profitable revenue.
Yep.
All right, now we enter the most speculative segment of our deep dive. This is not financial advice. This is our pitch to an imaginary investment committee based purely on what we just analyzed.
Okay, so my thesis here is simple. Funko has crossed the credibility Rubicon. They have proven, beyond a doubt, that they can protect margins. That 40.2% GM is their defensive floor.
And on offense.
On offense, they have a demonstrable, unique, idiosyncratic growth catalyst, Bitty Pop, on Walmart's top toy list, coupled with that visible execution on speed to market with things like KPop Demon Hunters.
Okay, so what does that strength in idiosyncratic execution mean for a potential trade idea?
The pitch is a long-short pair trade. The market has clearly signaled it's rewarding company-specific execution over broad sector trends.
So you go long Funko.
You go long Funko, FNKO, and you short a selection of comparable public toy companies, or maybe a broad sector proxy, like the consumer discretionary ETF XLY.
And the rationale there is you're hedging out the macro consumer demand risk.
Exactly. If the holiday season is flat or poor because of the economy, the short position protects you. But you still benefit from the outsized growth and execution delta of Funko over its peers.
So you're betting on their relative outperformance.
Right. And the next catalysts, early 2026 updates on Loungefly and speed to market, should sustain the momentum that this report started. The setup is strong.
That's a fascinating way to frame it. All right, let's wrap this up. The key takeaway from the Q3 call is this successful transition to a focus on execution and margin quality, centered around that impressive 40% gross margin.
That's what the market rewarded with that immediate 10% stock bump. It's a clear signal.
A major vote of confidence in the new management team.
For sure. Especially in their ability to monetize IP efficiently, even if sales are slowing down for a bit.
But that shadow of the debt still looms large. The CEO expressed confidence in selling the next 1 billion POP products. So given the significant $241 million debt and the cautious U.S. market, here is the final thought for you, the listener, to chew on. How quickly must that international expansion into Asia and Latin America and the DTC enhancements like the AI Pop Yourself builder accelerate to turn this controlled offense into the sustained substantial growth they need to put those refinancing concerns to rest for good?
It's a compelling race, isn't it? Operational velocity versus that September 2026 maturity date. It's a storyline we will definitely be following closely.
Absolutely. Thank you for joining us for this deep dive. We look forward to your thoughts and feedback.
Disclaimer. The discussion of securities and trade ideas in this segment is strictly for illustrative purposes and entertainment. Always consult a qualified professional before making any investment decisions.